Hello, hello. Hello? Can you guys hear me? Oh. Let's see. Hello. Okay, perfect. Hello, guys. My name is Theo, and I'm really excited here to introduce you Mr. Jens, an exceptional analyst and trader, who is gonna take over this session today. And I'm really convinced that you're gonna gain a lot of value after the end of this webinar. So please pay close attention to what Jens will tell you today about the subject. Please make sure you're gonna subscribe on our YouTube channel and you're gonna like this video. If you guys have any question at the end, even after this webinar finish, please make sure you type it on the comments below, and definitely Jen will answer all your questions. Okay. Hello, Jens.
Hello, Theo.
It's
nice to see you. So just let me type in here. Hello, traders.
Yep.
All the people joining us now. So yeah, I take over. That's correct, right? So hello and welcome to today's hot topic webinar. Today's topic, well, it will be one which is probably kind of irritating because after yesterday, you might think that we talk about yesterday's little crash with the Nasdaq dropping 3%. But today we want to talk about the bigger picture, the bigger crash, let's say, or the bigger drop in equities, the 30% we dropped from the yearly highs so far in 2022. And what probably is more interesting and more important, or let's say what you probably wonder is what can we expect for the second half, and what do we depend on, what do we need to see in terms of especially the Fed in this context. And that being said, yeah, brings us in fact to the first slide. And before, let me just see. I think you need to give me allowance here to share my screen, Theo. So right now I have here the saying that I'm not allowed to share my screen. Hello. Can you hear me? Yeah, perfect. So I think you need to give me the allowance to share my screen. So I'm not allowed to share my screen. So there's somewhere a little a checkbox where you say Jens is allowed to share his screen.
Yes, Jens. Sorry, I'm trying to sort it out.
I think it's if you type on my name or something like with a right click or so, then probably there should be a little tab saying which. Oh, now you have it. Perfect. No? There we go.
Okay, perfect.
There we go.
Sorry, guys, for that. I was trying to sort it out. Apologies. Thank you. Thank you.
So this is the first slide. So today's topic, again, after the crash. So where do we stand in the Nasdaq 100? Respectively, where do we stand in the overall market? Before we start and we jump over into the MetaTrader in this case, first of all, I'd like to introduce some admirals here, the broker standing behind this webinar series. So FX and CFD broker for over 20 years, fully licensed, fully regulated. And right now, also with a new offering, if I'm not mistaken, and this is especially true for the Nasdaq, that now you're allowed to trade as small as 0.02, if I'm not mistaken. In terms of the Nasdaq, when it comes to trading the DAX, Dow Jones, S&P, you have also the chance to go as low as 0.01. Don't ask why it's 0.02 in case of the Nasdaq. I think this has a technical reason. However, it's the reason I mentioned this is because it's now very, very easily possible to really manage your risk to really like cents, down to cents. Very attractive potentially also for people saying, I want to try out trading the markets, but I want to start with a small account. Long thing short, head over to abnormarkets.com for further information on this new offering. And also here, feel free to reach out to a broker, not just fully regulated, but with offices around the globe. And thus, chances are high. I mean, we are here and talking in English, but chances are very, very high that if you are not a native English speaker, you have a chance to talk to someone in your respective language. So feel free to check out the contact details at the end of this presentation, respectively. You can also find them on the website. I will share the information here around the contact details at the end of this webinar. Now, what I want to do is I want to head over here into the MetaTrader 5 and give you here first of all the picture, the overall, the big picture, let's say, when it comes to the Nasdaq. And so I mean, it's quite clear we are in a clear downtrend, which accelerated here once again. That was after this sharp rally. That was the Fed meeting in March, was mainly and fully priced in back then, and then things started to get very, let's call it, restrictive when it came to the Fed. So it was that the dot plot back then was already pointing to a very restrictive path, and the Fed back then in March said, okay, yeah, this is exactly what we deliver, and not just that, but with continuous pressure in terms of the consumer price index and inflation pressures rising. Then also here from around April onwards, it was at the beginning of Q2, things started to really accelerate on the downside once again. That was not just the main driver, which especially here at the beginning of March, respectively at the end of February, was a driver lower with the invasion of Russia and the Ukraine, but also here and mainly due to the inflationary pressures building, and thus market participants expecting the Fed to aggressively hike in the upcoming meetings. Then things really started to look really bad from a pure technical standpoint. So technically speaking, we say we are in a downtrend if a market sees a drop here of a minimum 20% or more than that from its recent highs, and we entered bear market territory, not just in the Nasdaq here, but also, let me just head over to the S&P 500, who has not seen that strong losses or huge losses. In terms of the Nasdaq, we were down at one point over 30%. Here, in case of the S&P, we were down around 25%. The reason for this difference is while tech stocks have a big impact and a great weight, let's say, here in the S&P, still it is a broader. There's also value titles, and also, for example, oil companies, Exxon, respectively, Occidental Petroleum. So the big oil companies, energy stocks, which performed extraordinarily well, and thus were capable of holding, let's say, the S&P above water, let's say, until we then dropped more than 20%. That was here around, let me just see, I think it was here in June when we finally entered, also on a closing basis here, when we entered the bear market territory. But long thing short, coming back to the Nasdaq, so main driver lower, where certainly the restrictive outlook from the Fed, in addition to the restrictive path with rate hikes, there's also now quantitative tightening taking place. So that means that the Fed is reducing its balance sheet, and main driver for especially this extraordinary run here after the COVID pandemic lows, where we bottomed out, that was in mid-March 2020. We saw the Nasdaq, the Nasdaq here, more than doubling. And in fact, we nearly tripled, in fact, and this within a time span of 3/4 of a half or something like that, a year here. And then now seeing the market correcting, that wasn't because the overall outlook for tech stocks was that great, but because liquidity was delivered, and people just didn't know what to do with their money. And in addition to that, there was also COVID. There was also the staying at home approach. There was lots of retail traders heading to the markets and buying stocks, tech stocks, those which were most discussed, let's say. So there was lots of buying taking place, with all the cheap liquidity driving stock prices to extraordinary heights. That was already taking place here in 2020. That was in the second half of the year. And we continue to accelerate. Then first signs of the impact of higher yields could be witnessed here. That was in March 2021, and there were already some stocks which never recovered from this pull in here, which we got to see in March 2021. Tesla, for example, recovered really well and continued to rise extraordinary here then on the upside, and after consolidation phase, that was then in March here 2021. After consolidation, then we accelerated once again on the upside. But Tesla is really it plays in its own league, let's say. It's its own story. It's still highly positively correlated to the tech sector in general. We're not talking that much about Tesla here in this context, but it's a growth story which continues, and especially now with electric vehicles taking over, and this let's call it the green revolution taking place, with all the developments in the energy sector, and trying to be not that dependent on fossil fuels and so on and so forth. This is all in all a sign that Tesla's rise higher, which went hand in hand with this move here in the Nasdaq, in this case, is potentially here to stay. But nearly all other tech names were completely destroyed then here, especially after we topped out and things started to really turn, let's say, with a more restrictive approach, which could be foreseen to some extent in the second half of 2021, when inflation picked significantly up. And this is also something we want to look at then, and where the upcoming numbers are very, very interesting, because now the question arises more and more: are we about to potentially peak out? So now the thing is, the question of today's webinar here is, in fact, the question is, what can we expect for the second half of 2022? So not just in terms of overall macro fundamental players or drivers, but also in terms of the Fed, and then going hand in hand with that, what can we expect for the Nasdaq in this context? So first of all, purely technical speaking, to see the picture brightening, let's say, what I want to certainly see is, I want to see the Nasdaq pushing back above this blue line here, this blue dotted line. This is the region. Now, if we zoom out once again, this is the region of the March 2021 lows I just mentioned. And once we broke it and weren't really capable of recovering, especially respectively, not especially, but respectively, when we dropped it once again, that was shortly before the last inflation print, which we got to see around 2 weeks ago. There was a consolidation taking place, and I was already expecting a break higher from here after we held the March 2021 lows. And then there was this sharp drop or sell-off to some extent on a Thursday evening. The numbers were released. They were released here at the 10th of June, while we already saw, that was a Friday, when we already saw a break below and close below this consolidation phase we built here on the 9th into the last hours of trading, last 2 hours of trading. I was really surprised to see that. I was really like, to me, initially, it looked like a fake out, but when then numbers came in above expectation in terms of inflation, and once again accelerated here the expectation around the Fed to come out very, very restrictive in the upcoming meeting, then and hiking rates by 75 basis points, which was the first time since 1994. And in addition to that, not just the first time since 1994, but the Fed never ever before hiked into a bear market, an official bear market. So that's something which is completely surprising, because usually you expect the U.S. central bank to act kind of, let's say, it helps, or it stabilizes equity markets especially, and it's not hiking rates too quick, too fast, to make sure that the overall bull market, or the economy in this context, and especially probably the employment situation around this, is not attacked, respectively, is not attacked is probably a good word to put it. So they really try to keep the economy going and don't hike too aggressively. But things now turn a little, with especially Joe Biden and the Biden administration seeing lots of headlines given their overall policy approach. People in the US being already very divided, which could be seen here, especially during the US presidential election in 2020, I think, with a very, very a tight race between Biden and Trump back then, and really being a 50-50 race in this case. And now inflation picked up, and people really face the headwinds of rising gasoline prices, rising energy prices in general, rising food prices. And we have a midterm election at the end of the year. And while Biden at the beginning of the year called inflation an political asset, which is something you can usually play with, he probably has changed his mind on considering it being an asset, and right now it's a liability. And people see him as the reason for the price, the pressure they face here. And that being said, now delivered, or in fact forced the Fed to step up and do whatever it takes to dampen inflation. The problem with inflation right now is that the inflationary environment is not caused from a demand perspective, where you could now go and say, well, we are more restrictive and we hike rates into this environment and we make money more expensive, and thus we dampen the overall inflationary environment. But it's a supply inflation. It's due to supply chain issues we see around the globe, and this the money not finding enough, let's say, stuff to buy. That's probably a good way to put it. So even if the Fed now comes out and says we hike rates, that not necessarily drives inflation lower, or at least not as quick as it needs to be driven lower here to take the heat, especially from the people in the US, respectively, in fact, around the globe, in fact. But we are here facing, we're looking at US equities especially. So long thing short, what we want to see from a technical standpoint is that the Fed is here easing, or at least not coming out as restrictive as expected. And I have to say, chances are high. Why? This is something I will make a topic in a few seconds. But it's not just the Fed, but also that the technical pictures, the technical picture here for the Nasdaq starts to really brighten up, and this is something I would expect to see if we make it back above the March 2021 lows, respectively here above this blue line, which corresponds, I'd say, roughly speaking, with around the region around 12,500 points. So now the thing is, we failed, at least as of now, to break above this trend line here. And especially yesterday was a devastating day for the Nasdaq. I have to admit, I'm not really sure what's the main driver for the bearishness we got to see, but there's also a chance attached to that. So whatever reason there was that we got to see the selling pressure here, now the market is probably about to show that it's capable of making a higher low. If we make a higher low and we see another attempt of a break higher, which could be, by the way, which could be driven by good earnings, especially in the tech sector. Lots of bearish news is already priced in, I'd say. So in this context, for example, when we look, for example, at Tesla here, so many people expect, for example, delivery numbers to come out significantly below expectations, respectively, not expectations, but expectations dropped already quite significantly. So after the last delivery numbers, which came out at the beginning of April, if I'm not mistaken. Yeah, first quarter, sure. So at the beginning of April, expectation rose as high as 350,000, I think, in terms of delivery numbers for the second quarter. The thing is now that we saw, due to supply chain issues and the lockdown, especially in Shanghai with the Gigafactory, for example, that we now saw a significant drop. And there's many also analysts and investment banks in this context who already took down their expectation here. And I think we are now down to 250 or so. I make this a topic, by the way, because it's also a potential driver for the stock in this case, or for the Tesla stock, which I consider, if this let's call it bullish environment for the Nasdaq plays out, is probably or will find a potential outperformer in Tesla in this context. But coming back here to the delivery numbers, so expectations are already quite low given supply chain issues, given the lockdown and the Shanghai Gigafactory. There's also some Bitcoin exposure in terms of Tesla. If you're followed here the developments around Tesla in 2021 already, you probably have seen or have heard about that Tesla had some of its cash reserves or some of its balance being transacted into, respectively changed into Bitcoin. There was also a story at the beginning of 2021 when Elon Musk, for example, talked about that you're capable of buying your Tesla now in Bitcoin, for example. Long thing short, so it's lots of negative news, which are already most of it's mostly priced in. And if we get to see now a little surprise on the upside, so things are not as bad as some market participants expect. And this is not just true for Tesla, but this is also true for other companies. Like remember Microsoft, for example. Microsoft came out, it was several weeks ago, and talking about some negative effects the developments in the currency environment have on their revenue guidance for the upcoming quarters, and then that probably they have to reduce their EPS expectations around EPS or EPS guidance, respectively revenue guidance, due to the volatility in FX. Here, the same is also true for companies like, I think, who was the last one talking about this? I think last I was reading about it. I think about Nike. That was already yesterday. By the way, Nike is also a topic. It's not tech related, but definitely something to keep in mind. Similar to Walmart, to Target, for example. Again, long thing short, lots of negative news is already priced in. That's one potential driver. The other is that I just saw that I think the final numbers for the GDP in the US came in. Let me just see, by the way. So this is a statistical aspect, and we want to dig deeper into in a few seconds. It's S&P 500 related, but very positively correlated to the Nasdaq. But in addition to that, let's just jump over to a very great source when it comes to economic numbers. And we head over here to indicators, countries, and then to the United States. And let's have a look here at the GDP growth rate. These numbers were just released. Here, there we go, 29th of June. They were just released, minus 1.6%. We're expected positive here. That was already, this is now the final numbers, not the second estimate, not the first numbers, but first numbers were already released in April, at the end of April, came in surprisingly below zero in this case, so means we are in recession. So, well, not technically. Technically, we're in a recession if we have now a back-to-back GDP print. So the next GDP print, which comes in below 0%, means we are in a recession, technically speaking. And again, and that was something which is also surprising. First numbers which came in, you can't see them here, came in at minus 1.3%. Then they revised it on the downside, minus 1.6, 1.5, and now they came in final numbers minus 1.6%. So showing that the economy, due to potentially, most likely due to the very restrictive monetary approach and fiscal policy not providing the people in the US especially with these stimulus checks and so on and so forth, that the economy in the US is potentially aggressively slowing down. So that being said, is probably one reason to say, well, this is already one reason why the Fed probably should be not as restrictive as expected. What is this? What we are referred to? Well, first of all, due to the we can also open this here, by the way. Let's come back here and not just look at the GDP numbers, but also the inflation rate, which headed to the highest levels. And here's the last print that was on the 10th of June, I was already talking about, at 8.6%. These are the highest prints since the early 90s. This development here was countered then with a very restrictive approach from the Fed, with some hiking rates at the meeting. You probably remember 2 weeks ago we were here at the Fed meeting together and saw that the Fed hiked by 75 basis points. I highly recommend, by the way, reading or listening to the event itself, and where we covered already the expectations around inflation, dot plot, and so on and so forth. So we don't need to dig too deep into this right now, but give a forecast of what to expect next. So we see a print at 8.6% above expectation, which was at 8.3. And so now, that being said, delivered or resulted in, probably that's a better way to put it, resulted in market participants not just expecting the Fed then to aggressively expect to hike at the June meeting 2 weeks ago by 75 basis points, but in addition to that, they also expect the Fed to hike another 75 basis points here at her July meeting, which takes place at the end of this month, so 4 weeks from now. This is very interesting because before the latest inflation prints here, we had an expectation of 50 basis points, which now headed up to 75. Very restrictive, potentially also one main driver. You can see this here, by the way. If we go back 1 month, so to the 27th of May, this is great what the Fed Watch tool delivers here. So you can keep track on what market participants expect the Fed to do monetary policy-wise at their next meeting. So what you can see here is 1 month ago, we were at 2.3% for a 25 basis point hike, while market participants expected. So right now, look at where we stand right now. So this is the current rate. It's 150 to 175. 1 month ago, market participants expected here the Fed to go 2 times 50 basis points, which would have brought us to 175 to 200. So now market participants expecting another 75, which means that the market is expecting 50 basis points more than they expected 1 month ago, which is already showing what I'm talking about what I mean when I say there's lots of restrictive monetary approach being baked into the price, which is already one of the reasons why we saw this drive lower here. And again, that was already a strong reaction, and then we rolled over with CPI print, which then resulted in market expectations or market participants expecting an even more restrictive monetary policy approach, which is also adding or giving us a clear conviction that the market participants are very focused right now on what the Fed will deliver at the upcoming meeting. So 75 at the next meeting, and now things are getting interesting. So remember, we are at 150 to 175 right now. This is the current rate. So if we hike by another 75, we are at 225 to 50. And then we only have 3 events left here: September, November, December. And if we head right over to the December meeting at the end of the year, you can see that market participants expect, with an increased likelihood, a max of 350 to 375 basis points with over 50%. So that means we have 200 basis points to go on the upside in terms of Fed rate hikes and expectations from market participants. We already have here 75 less, which leaves us with 125 for the last 3 meetings here, which means, I'm sorry, is it right? 75, 200, yeah, 125, 125, exactly. So now that means one with 50 basis points, and then only 2 other events with 50 and 25. And if you carefully watch, then you will find out that in September and in November, market participants right now bake in 50 basis point rate hikes each, and then only 25 in December. And I say, this is only an option if the upcoming GDP data here now convinces on the upside and is not pointing to a recession. There's another event, the Senate Banking Committee and the semi-annual testimony, which we got to see. That was, I think, a week ago, where politicians in the Senate, respectively in the Congress, were asking questions towards Jay Powell. And if you carefully watch and listen to that, there was also Elizabeth Warren. She's a Democrat. And Elizabeth Warren pointed to Jay Powell and said, please don't drive our economy over a cliff. So already saying, hey, we see what you're doing here. Well, we are happy that you're fighting inflation for us, but please don't fight it too aggressively, else it's not just that we have an inflationary environment, which we potentially don't come out as quickly as we hope, but we also see a recession, which means we are in a stagflationary environment then. So stagnating economy, US economy, while inflation keeps pushing higher due to the supply chain issues and interruption of supply chain and so on and so forth. We got to see right now, and developments in the energy market, oil market, gas, and so on. So that being said, now leaves us, or leaves me, let's say, with a clear expectation that we are most likely get to see a market participants pricing out a more restrictive approach. I think this is the heaviest restriction or restrictive monetary policy approach we get to see. I think we are more likely to get only 25 and 25 in November, if we get them at all. Probably there's only one 75 basis point rate hike here in July, and then none further rate hikes at the September, November, and December meeting. Due to, again, the GDP print, which came in again below expectations today. And there's another aspect I'd like to point out here. And this is something I just realized I haven't opened it yet, but I will. Let me just here head over to a guy you probably have heard about before. His name is Michael Burry. Michael Burry is a guy you probably have seen as Christian Bale, the actor in the film The Big Short. So this is the book from Michael Lewis. And he was one of the guys who bet on the collapse of the global financial system in 2008, 2007, and as a hedge fund manager. And he pointed something out that was, let me just see here. He pointed something out which I talked about earlier this year already, at the beginning in January around, and was thinking about this. But I didn't know that there was let's call it a theory behind this, or that there's a name for this, and it's called the bullwhip effect. And the bullwhip effect, let me just go over here. So we won't now go here through this. Yeah, great. So this is a German article. It's a distribution channel phenomenon in which demand forecasts yield supply chain inefficiencies. We don't want to dig too deep into the overall theory behind this now, but I want to explain it in a very simple way so that we understand why this is potentially bringing inflation down, which is already forecasted from Burry here in this article. At the beginning of this year, when inflation really picked up, I made it very roughly, and I said, well, for example, that came down to stocks we were watching back then, like Netflix, for example. You've probably followed the price action and seen Netflix already falling off a cliff after its earnings releases earlier this year. So lots of downside pressure. And so the question was, or the question I had is, what about the growth outlook now for the future? And the growth outlook wasn't that promising, and it continued to weaken. And the next quarterly report was also worse than expected. And I think the reason for that was mainly because people are now wondering, do I really need, let's say, 3-4 streaming providers here for my pleasure? Do I really need Netflix? Do I really need, beside Netflix, I don't know, Disney Plus? Do I need Amazon Prime? Do I need Hulu? Do I need really every streaming provider available? I mean, I have probably other needs right now, like making sure that I keep the lights on, or making sure that I have enough enough food to eat. I really have, I wonder if it's probably makes more sense to save. So that was the story I thought about at the beginning of the year. And now when you carefully watch most recent numbers which were released, and earnings guidances, respectively revenue guidances from a Target, a discretionary retail, respectively consumer staples in this context, so Walmart and so on and so forth, you could see that they were already talking about having a problem getting down their inventories, because there was a clear shift in consumer consumption, which could be seen. And that's, in fact, the same thing I was thinking about earlier this year, with inflation now picking up, because people don't demand pleasure anymore and joyful environment. I mean, surely we want to have a nice environment and meet friends and watch a nice film and go, let's say, to a restaurant. And so especially after COVID now, and with being locked down for several months. But right now, it's more like I want to save what I have. Respectively, I demand stuff which really brings me through times of trouble, let's say. And so with this shift in consumer consumption, we get over to this bullwhip effect, because now, let's say companies like Target, like Walmart, but also Nike, for example, talking about inventory in this case, people will think about, do I really need to buy the next pair of sneakers? Or do I really need this? Are the sneakers which I just bought 6 months ago still fine to go, let's say? So which will naturally result in a drop of demand in these goods which they have stored and they have in their inventory, which means they will potentially sell them at a lower price, which means consumer prices in this area at least will drop. That doesn't necessarily mean that oil or gasoline prices will come down. They will probably stay elevated, but still there's some expectation, and I think there's a good reason to expect this, that prices will naturally drop, which means there is a potential so-called deflationary impulse here resulting, which means there is probably disinflation, as he points out, later this year. So a peak out in inflation, which will mean nothing more than the Fed will probably reserve itself on rates and QT. QT is short for quantitative tightening, which means, coming back here to the Fed Watch tool, they're potentially pricing out the restrictive approach market participants priced in over the last months. That being said, and knowing about the positive correlation between not necessarily quantitative easing, but easing, respectively, a more dovish monetary policy approach here, and which aggressively pushed equity, in this case tech stocks, aggressively higher, is then a potential reason to be optimistic that potentially the bottom is in here, or at least we get to see a last final flush on the downside, which is probably making a lower low, but there's no continuation on the downside or no follow through, and then markets are reversing and breaking this channel here on the downside. That doesn't necessarily mean that we are now about to head higher and go for new all-time highs and so on and so forth. I wouldn't be that optimistic, but at least I could imagine that we are close to a bottom here in this area, and that we are potentially about to see a break higher, and especially if we can make it again above 12,500 points, that here we have a good chance then to see a stronger second half. And this is also something, so this is the technical picture, this is the overall fundamental picture, what currently drives especially tech stocks here in the Nasdaq. But in addition to that, I'd also like to point out some historic numbers. Historic numbers here in this context. So in this case, we're not looking at the Nasdaq anymore, but we're looking at the S&P. But this is a fantastic work here from Ryan Detrick. I highly recommend, by the way. I'm following him on Twitter. You can see that I'm not the only one following him. It's over 100,000 people. So if you're on Twitter, feel free to follow Ryan here in this case, because these statistical works are just phenomenal. So they're just really great to then, once you formulate a thesis here, to give further conviction or step back from your game plan, which you probably formulated from a technical fundamental standpoint. So what he does here is he looks at what happens after the first half of the year if we saw a very weak start into the year. And what you can see here is that he points out these bad starts into the year. Bad starts means the first half of the year was not that promising. And right now we are over 20% year to date underwater in the S&P, nearly 30% in the Nasdaq. So we can definitely talk about a negative start into the year. But as he points out here, being down halftime doesn't always mean more trouble ahead. So what he does here is he goes back till I think 90. Okay, perfect. It's something he points out here. So he goes back till 1928, as you can see. But very important to note, performance back to 1950 incorporates the performance of the predecessor's index. So S&P 500 earlier was the S&P 90. So very important to know that. But still, it's the same idea behind the index. And if you look here, 1932, that was the Great Depression. Year-to-date return after 6 months into the year, minus 45.4%. Rest of the year, we saw a sharp reversal in this case, and we finished the year still lower, but we in the last 6 months we had it higher, 56.2%. 1939 minus 70.4%. So he looks at the index being down more than 15% in this case. Rest of the year we still closed lower, but we finished in the last 6 months 14.7% higher in the S&P then. 1940, 1 year later, minus 19.9%, plus 6%. That was the weakest performance, and so on and so forth. As you can see here, so if we performed bad in the first 6 months of the year, the S&P here 5 out of 5 times closed higher compared to its low. So it's not that it means we are closing higher for the year. But it means that we are here at least closing higher compared to the lows we marked in the first half of the year. I'm not sure if we should look at the average because of this extraordinary performance in the second 6 months of 1932 here, but probably we'll look at the median. But overall, it's 15% around. We are trading higher. So if this plays out again, then we certainly have another, let's call it a statistical driver, probably, which will mean that we are potentially headed higher if we combine all these, even though, and this is very important to note, and this is also a chart which I haven't yet, wait a second, let me just see, I think it's here. He points out that bear markets are better without a recession. If we enter a bear market, and if this bear market then is a recession in this context, then the bounce will be much stronger. Respectively, we're more likely to exit this bear market more quickly if we do not enter a recession. Again, right now, technically speaking, we are not in a recession in the US, but chances are high that we'll enter one later this year. And if we enter one, then chances are high that the bear market is potentially longer than it was in the past, once we entered a bear market but did not enter a recession in this context. So this is definitely something worth noting in this context. And so long thing short, if you ask me now, is the bottom in? I would say depends on whether we make a higher low now or not, and if we finally break here this down trend line. I think looking forward 18 to 24 months, the Nasdaq is risk reward wise very attractive for long engagements. I'm quite sure that 18 24 months from now, we are trading higher in the Nasdaq. I think one very strong performer in such an environment, if this idea plays out, I'm not 100% sure, so that this is at least my view, my opinion in this case. A very strong stock to watch in this environment is potentially the Tesla stock. You should keep an eye on. I think Tesla, in an environment where we saw the bottom now and tech stocks heading higher, Tesla is a potential outperformer given its recent numbers. It presented respectively the guidance it gave and will potentially give in the upcoming earnings release that will be at the 25th of July, if I'm not mistaken. I have to look this up. And the key level, short-term key level to watch and above which a stabilization I consider to brighten the overall picture is around 12,500. So these are the March 21 lows, especially if we break here back above 13,000 in this context and can hold here above 13,000 points. I think this is a strong sign that the bottom might be in, and we are potentially then headed higher. Not really sure how far. I think we will have a high chance, elevated chance to close the year negative, at least after the strong move lower, but probably not as bearish as right now signs seem to be for a close of the year. So I think somewhere in a range between minus 15%, which means, but still from these levels, a sharper bounce, which will bring us back to probably a little above 14,000 points. So that's it. That's it. In fact, on the Nasdaq and the outlook and what to expect after, let's say, after the crash. Let's head over here once again. I promised it at the beginning. Here, the contact details. If you have any wishes, respectively, any questions regards in regards to markets and their offering, head out and then feel free to contact them via email, also via the Facebook page, also via or by calling them. Also feel free to subscribe to the YouTube channel, and here in this context, leave a thumb up here if you like what you saw. If you have any questions, in regards to other markets we should look at, or you'd like to get an idea on, feel free to post them below the video if you watch the recording now on YouTube. I just see here that here in this context, there's no further question on markets. But 1 second. So I just see that Karim asked, how interesting to watch these start. Please, how price act as Fed meetings goes by. What are your forecasts for the USD? Let's just head over here to Euro USD. So depends on which currency you look at. So if you look at Euro USD, I think the euro is doomed to fail. So long thing short, I don't think that the euro has lots of potential, but doomed to fail in this context doesn't necessarily mean that we go straight down to parity and below that. And even though this is my overall expectation, but I could imagine, especially if the Fed eases, let's say, and is not as aggressive as it's currently priced in. And this plays into my overall outlook for the Nasdaq. Then only from another perspective, I could imagine the US dollar to potentially I could imagine the US dollar really to weaken, and also against a weak currency as the euro is, even though if I play the USD from the short side, I prefer to go with, for example, here in this case, gold, for example, where I could then expect, or where I expect, in fact, a bull run back above 2000 USD. So this is probably something. Yeah, this is probably something how I would play it. In fact, I wouldn't necessarily go with another weak fiat currency, in this case the euro, because I think the ECB tipped her hand in this case. So I think they are standing with the back against the wall, and I don't think that they have any chance to hike rates more aggressively than 25 basis points now in July, then probably in September. And I think they potentially they lost already the game. So I think the euro is not a good bet longer term. Still could be that relative weakness in the US dollar is driving a euro USD at least higher, but I don't really see euro USD pushing back above 110 significantly. But in the long run, even with a weak USD, the euro being even weaker and potentially being prone to push down to parity, probably in the below that. By the way, euros per franc, I think today pushed below parity, if I'm not mistaken. And if I want to play the USD short, then I'd like to go here for gold from the long side. And yeah, so I hope that this answers the question. By the way, here's the risk disclaimer: fully regulated broker. So there was no trading advice or something. It was purely educational, but my personal opinion on how I view the market and how I expect things to play out in the second half of the year for the Nasdaq. I hope you enjoyed it, and I wish you all the best. Happy trading, watch your stops, and talk to you again soon. So all the best. See you. Bye-bye.